we are now officially being recorded, so watch what you say. Okay? My name is Dr. Logue. I've been a full-time teacher here for 26 years, so I will spare my two undergrads the story of my life. We'll just kind of get right into it. You'll be taking a tax class, as I mentioned before we started recording. All your tests are going to be take-home. All these lectures are going to be recorded. If you go to Canvas, give it a couple of days before I get things kind of set up. What you'll see on Canvas, I will post class notes, kind of like this. This is a class note for Chapter 1. I'll also hand these out to you guys, but you'll get the class notes handed out. I will also post answer solutions to problems in the back of the chapter. When it comes time for a test, I will give them to you or email them to you on a Tuesday night. And then I'll ask you to kind of get them back to me by about, give you till about Monday, the following Monday, around noon or so. That should give me enough time to grade them Monday afternoon so I can give them back to you on Tuesday. So you'll have about 5 or 6 days to work on a test. Sound good? And here's the other thing, since the tests are take-home, it's possible we may actually be done this course before December. I know that's going to be horrible for some of you, but having taught this class in this format, since I'm not wasting time in class giving you the exam, you'll be able to finish a few classes early, so that's pretty nice. Okay? All right, let me hand out some Chapter 1 notes. You picked the worst time to take a tax class, or maybe it's the best time to take a tax class, because what happened this year? Yeah, they changed everything. So here I am cruising along, everything is fine, and they went ahead and changed everything on me. The year I have to teach this online as well, so here we go. Alrighty, I actually really enjoy taxes. Let me turn this light down a little bit. And the reason I enjoy taxes is it affects everybody. Every single individual, you're either on somebody's return, or in the past you're being claimed as an exemption from somebody. Every corporation has to do a return. Every estate has to do a return. Partnerships have to worry about taxes. So it's just all over the place. The one thing I want to tell you, try not to make sense out of taxes. Who makes tax law? Congress. Is Congress logical? No. Congress is politically motivated. So I'll try to keep politics out of this, but there'll be times where it's really hard to explain why they're doing what they're doing. Just kind of accept it, because that's how they agreed to do it. Okay. Now, what do you have here? We've got the little intro to taxes. And the first part, you can see I give best examples and best problems. In the chapter, you'll see examples. And the really good examples I try to highlight up top. And the best problems at the back of the chapter, I'll also highlight. So when you are working on your exam, which won't be for like 3 or 4 weeks, those are the best examples and problems for you to focus on. We will go over more in class, but those are the best ones. The first section of the chapter is just very general overview. I'm just going to talk about taxes. Don't worry about taking notes. Once we get into types of taxes, that'll be a little bit more important. So don't worry about what I'm about to say for about the first 30 minutes or so. Just kind of sit back, enjoy the ride, okay? All right, a little bit of terminology. And I do this only because the book is going to use this terminology all throughout the course. You see tax base. That is simply the figure upon which your taxes are calculated, known as the tax base. The tax rate, well, that's the rate that gets applied to your tax base. You see a progressive rate. What does that mean? Some taxes the more your base, the more your tax rate is. Many of you probably don't have the book yet. On the inside cover of the tax book, it has the 2018 tax rate schedule. So I'm going to put it here on the screen. And if you take a look at it, say you got somebody single. Your first $9,000 worth of income, taxable income, is taxed at 10%. After that, it jumps to 12%, the next chunk of income. Then it goes to 22%, 24, 32, 35, 37. So basically the way taxes work, the more you make, the higher your rates. So it's not just one flat rate. It's the first chunk of my income gets taxed at 10%, then anything over that gets taxed at 12%, then anything over that gets taxed at 22%, and it moves up that way. That is different than a flat rate. Okay, a flat rate is simply like our state taxes in Pennsylvania. It's a little over 3%. Whether you make $10,000 or $10 million, you're paying tax at a rate of 3.06%. Okay? Progressive rate for federal taxes. Don't worry about a regressive rate. The book does kick it out. Some taxes, once you make a certain amount of money, you're no longer subject to the taxes. A good example of that would be the Social Security piece of FICA. That once you hit a certain amount, your employer will stop taking FICA out of your pay, and you don't have to worry about that. Marginal tax rate is a very important concept. That's the rate that your next dollar of income will be taxed at. Say you're a finance person and you've got clients. It's really important to know if the next dollar of income that your client's going to make is going to be taxed at 10% or 30%. So marginal tax rate, very important. Don't worry too much about average tax rate. That just means how much tax did I pay on my taxable income? Well, some of it was taxed at 10%, some of it was taxed at 12%, some of it was taxed at this rate and that rate. It's kind of just a general overall average. Okay? And I don't care about effective tax rate at all. In the book, you see where I have CT2 through T13? Those are things at the back of the chapter where you can figure out what your tax would be from 2017. They also have a tax rate schedule. And see inside cover for the 2018 tax rate schedule. That's what I showed you right here. So this is the current tax schedule. Now, we've heard the taxes have changed for this year. Okay? What are the big changes? Well, number one, they dropped the rates. Those rates are lower than before. If I were to go to the back of this book, I would see that, yes, we did start at 10%, just like we do now, but then, this is last year, so I don't want you worrying about it too much, but last year, you started at 10%, and then you went into 15%, then you went to 25, then 28, then 33, then 35, then 39. They've kind of replaced the 15% bracket with 12. And the 25% bracket with 22, so forth and so on. So Congress lowered the rates a little bit. That's one of the big changes for this year. Okay. Now, other changes that you might not be able to understand if you've never done a tax return before is there's no longer exemptions. Does anybody remember what an exemption is? Okay. Say you can qualify, say you're married with 2 kids. You would be able to deduct a little over $4,000 for you, $4,000 for your spouse, $4,000 for kid 1, $4,000 for kid 2. They did away with that. So there's no more exemptions starting in 2018. But what they did, and we'll get into this more in chapter 2, is they increased what's known as a standard deduction. And then they also increased what's known as a child credit. So all in all, for most people, they're going to be paying a lot less in taxes. Okay? Right. Now, as I'm still getting way ahead of myself, I'm going to show you an example of how taxes worked last year. I cannot show you in the book an example of how taxes work this year because the tax forms haven't come out yet. So we can't go on the IRS's website and go get ourselves a 2018 1040 tax return. They don't exist yet. So we have to look at last year's return, and then I have to kind of explain to you what's going to be different. So let's take a quick peek. We're going to take a look at how last year's tax return would work, okay? If you have the book, I am jumping to page 2-8. For those of you sitting here in class, don't worry about it because I'm putting it right here. And I'll see if I can make this a little bigger for it. Ooh, I'm going the wrong way there, Logan. Okay. You're just sitting back, not taking any notes, right? All right. Okay. This is last year. Your name, your social security number. Your social security number is your tax ID. This is a married couple, so you've got the social security for both husband and wife. They're considered one taxable entity. Filing status, you have to check a box. That's chapter 2. It's very important to figure out what the right box is. If you're married, filing a joint return like they are, you check that box. If you're not married, you might check off the single box. But there's some other crazy boxes there. Married filing separate, well, that means you're technically legally married, but you chose not to file a joint return. Does that happen a lot? Not that often, but it does happen. And the most common times it happens is you have a couple that have separated and they just physically don't want to get together and do a joint return. So they just go, you do your return, I'll do my return. There's really not a tax benefit for filing married separate. It's more, there's usually life issues get in the way and people file separately. There's something called a head of household right here. We'll have to spend a lot of time on that. That's a case where, hey, maybe I'm not married, but I'm a single parent and I'm supporting 2 kids. Is there a different status for me? Well, what's the difference between all these boxes? Well, it all depends on your race, or it affects your race. The single people jump into the higher rates faster than a head of household. And head of household will jump into the higher rates faster than a married filing a joint return. So it's much, much, much more favorable to be a head of household than single. But it's also more favorable to be married filing joint than head of household. So we have to really learn which is the correct box. You don't get to just pick whichever one you want. You are technically only qualified to be one of those. And the final box is a qualifying widow or widower. That's a case where you were married, your spouse passed away. They're not going to kick you into single or head of household status right away. So we'll get into all that in chapter 2. The next part where you see exemptions, this is something that people have been doing for decades. Everybody is used to figuring out who can I claim as a dependent on my tax return and then get a exemption for them. That is going away. There'll be no more exemptions in 2018. Does that mean we don't need to even worry about it? Unfortunately, no. We still need to figure out who would qualify as a dependent, because that's going to affect our filing status and our ability to take certain credits. So in a way, we still have to learn everything that it takes to qualify as a dependent. We just can't claim this last year's $4,050 reduction. Okay? It'll take us some time to figure all this out. We then have Okay, exemptions, in prior years, you would get one for yourself, one for your spouse if you're married, and one for each person you could claim as a dependent. So here we've got husband, wife, one kid, 3 dependents. We'll see on the back side of this form how that affects our taxable income. The next part of the form is income. I won't talk too much about this tonight. That's really chapters 3 and 4. But part of the course is figuring out what income is taxable, what is not. And you see things like wages and interest and dividends and alimony. Yes, alimony is taxable if you receive it. Child support is not, but alimony is. If you're self-employed, your business income, if you receive pensions and IRAs and unemployment and Social Security, we will spend lots of time in this area in chapters 3 and 4 to figure out what is technically income. Well, then you can start to reduce your income by various things. The next section here, what they call deductions for adjusted gross income, these are things that can reduce my income. We won't get into these much in chapters 3 and 4. Those are actually way down the road. But some of the big things that reduce your income might be money you've put into an IRA account will reduce your taxable income. Student loan interest that you've paid can reduce your taxable income. Alimony that you've paid can reduce your taxable income. But there's a whole slew of things that will reduce your income. That gets you to the subtotal called adjusted gross income. So 76.5, because they had $82,000 worth of things that were considered income, $5,500 of deductions. Looks like they popped some money into an IRA, getting their taxable income down to $76.50. Well, then on the flip side, whoops, wrong page. On the flip side of the form, we begin with that $76,500, and then we can reduce that amount by certain things. The biggie here, itemized deductions. What are they? Oh boy, that's a whole separate chapter. Itemized deductions are things like charitable contributions and mortgage interest and real estate taxes and state and local income taxes. And what you do, you do a separate form to try to figure out how much those are. Don't worry about them right now. There's also something called a standard deduction. Oh my goodness, what in the world is that? Well, depending upon your filing status, they let you deduct at least something. If your itemized deductions are higher than your standard, you go with the itemized. If your standard deduction is higher than your itemized, you go with the standard. So you take either your itemized deductions or your standard. Now, one of the things they did for 2018, because they took away exemptions, they upped the standard. That's good for a lot of people. That's very good for people that didn't itemize. If you did itemize, it's not so good for you because the increased standard doesn't help you that much if you're still going to itemize, and losing exemptions can hurt you. But if you didn't itemize last year, you're in very good shape. If you did the single went from basically $6,000 and change to $12,000. The head of household went up to $18,000. The married filing joint went to $24,000. That's very good news. That's what that 15.3 is. Then line 42 here, that's where they're taking those exemptions. We had 3 exemptions, remember? Husband, wife, and kid, a little over $4,000 each. They were able to deduct $12,150 from their income, getting their taxable income down to $49,500. That goes away, but their standard would be higher. This year, they would, instead of having 15.3 in itemized deductions, they could claim $24,000 in a standard deduction. So that would go up a little bit, but they'd lose this $12,150. What's this $6,429? That's the tax that would be due on $49,000. That's the starting point. Now, what do you do with that? You may be entitled to things that reduce that. Oh, like what? Credits. Oh boy. What kind of credits? Well, the biggies are child tax credit. There's a child tax credit here for $1,000. That one kid they had, that kid was worth $1,000. that actually reduced their tax liability from $6,400 to $1,000. Guess what? Anybody, well, I shouldn't ask any personal questions, but if you have kids, that credit's going from $1,000 to $2,000. That's huge. Very upset that my one daughter's got 3 kids. One was born this year. Last year, their child credit for 2 kids was a total of $2,000. This year, with 3 kids, their child credit's a total of $6,000. That will increase their refund by $4,000. That's pretty good. Off the record, you ever see the Altoona Mirror on January 1st? And they always have the person who had the first baby of the new year. And everybody's real excited. Hey, I had the first baby of the new year. Look at me. This is great. I got me a case of Pampers and a balloon. Wow. Okay, dum-dum, if you'd had the baby like 4 hours early, you get a $2,000 check from the government. So you don't want to be the first baby born in January. You want to be the last baby born in December. That explains why the first low child was born December 29th. Child was due January 3rd. I said, took the missus out on a little ride, hit every pothole I could find in Philadelphia. Next thing you know, boom, got me a child credit, got me an exemption. There you go, all right? Other things we'll get into, a biggie would be this credit for child and dependent care. If you put your kid in daycare for work purposes, you get a nice credit for that. So basically, this $1,000 reduced what they owe from $6,400 to $5,400. So do they have to write a check for $5,400? Well, no. You then compare that to what you had withheld in your paycheck, and it looks like this couple had $6,000 withheld. So they owe $5,400, but they already paid $6,000. So the difference is $571, and you can get that as a refund, or you can tell them to keep it and apply it to next year. They're anticipating refunds to be pretty significant this year. And remember I told you taxes politically motivated? Why do you think they did this? Don't try to think logically. Think politically, maybe think a little bit economically. Economically? What's that word? Economically? Sorry, State College, I don't know how to pronounce it. You got a new president. New president has a thing that says, hey, I'm going to lower taxes. Please vote for me. Okay, that happens all the time. But also, when you have a president that's very interested in trying to get the economy going, the thought is if we lower taxes, people will have more money to spend. If we lower taxes, companies will have more money to spend, hire more. So really, I think this was more out of a hopeful boost to the economy. Don't try and kid yourself. This was done for fairness and social justice and all that. It's usually done for political gain and or economic purposes. Boom. Okay. This will make a lot more sense by the end of this course, how this all works. Okay. All right, let's get back to this thing called types of taxes. And what I'm going to do, I'm now going to take a moment and I'm going to stop recording. And the reason for that, if I go for like an hour and a half and 2 hours, it's going to take a very long time to upload. So what I was told to do is stop recording like after every 30 minutes or so, take a little pause, and then just record it again. So instead of trying to upload one thing, you can upload 4 different things. So hold on one second.